Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. I'll get it out. What we're going to be doing this morning is talking about separating myths from truths. We're going to talk about investing and show you how the science of investing, if you will, what 50 years of academic research has been able to provide us, Nobel Prize-winning academic research. And we're going to start with the myths, all right? So here we're going with some common investment myths. Myth number 1, stock selection. Myth number 2, track record investing, market timing, and the cost of investing. What does this mean? Well, basically, one of the things that we see here, when you first go in and you talk to an advisor, and these are questions I sometimes get as well when I meet with someone for the first time. They're asking, like, what stock or investments do you like? This is where you get into stock selection. When you're talking about, they're looking for like stock tips, right? And how many of you maybe have done that or know of someone that have done it, let's say, right? Another is your favorite manager. Do you have a favorite mutual fund, for instance? How have they done? This is another one that gets into track record investing. So the first one, when you're asking about a hot stock pick, this is trying to figure out what stock's going to outperform another. These are active management things. When you get into market or track record investing, so this myth about choosing a stock based on the belief that they'll do well in the future, again, stock picking. The next one being track record. Well, hold on to that slide right there. This one, when we go through these different myths, what I want you to think about is what all of these are about active management. So when you're talking about stock selection as an example, what you're asking is, you're basically asking someone to forecast the future, right? And the same thing goes when it comes to track record investing. You're looking at, well, here's what they did in the past. They must know what they're doing, therefore they're going to do this well in the future. This is where, when we see a mutual fund manager that outperforms the market as an example over some period of time, we think that they've got it figured out. We invest with them, and then we're disappointed to find that they underperform. I've had many clients say, in fact, as soon as I invest in something, it's going to go down, because that's been their experience, right? They go out and they pick one that's done so well, and then they get in it and it goes down, and they think it somehow has to do with their selection. It's because of the way this works with active management, all right? Another of these is market timing. So how many times have you said, where is the market going? What do you think? Is it going to go up? Is it going to go down? This is another common question. And what are you, again, looking at is some way of predicting what the market's going to do. No one has that ability. I know, and I've listened to some of the biggest names, including people like Warren Buffett, who in fact said the same thing. I don't know what the market's going to do next year. Certainly not next week, next month, next year, in the next 2 years or 3 years for that matter, but I know long term that the market is going to provide a certain return that's going to help me stay ahead of inflation and taxes, and that's what I'm seeking. Now, I want to minimize my risk in the process, and the other thing I want to do is myth number 4, which I want to minimize the costs when it comes to what investing, in my investing. So in other words, with mutual funds, with actively managed funds in particular, this cost can be high. There are also certain hidden costs you don't see, and we're going to talk about that and how you can minimize those as well. So myth number 1, stock selection. This is where you're asking basically in stock picking, relying on stock selection as an investment approach. So what we're talking about is we're basing it on a belief that somehow a money manager or an advisor is going to know which stocks are going to beat the market in general and therefore be able to give us a bigger return than the market. But have you ever, does this in fact work? And if you're investing in mutual funds, what you're doing, of course, in actively managed funds is you're hiring a money manager. You're paying a money manager that's running that mutual fund or group of them, that with the expectation that they're going to be able to give you a bigger return than if you just invested in an index fund, much like we talked about earlier with the index bet that Warren Buffett made. So does that in fact work? Well, let's take a look. Have you ever owned a fund, in fact, a mutual fund that you were invested in, and they closed it or merged it into another fund? So, what happens there? Why does that happen? Well, of course, it didn't perform. Well, now imagine that you didn't have to count that when you're talking about how your mutual funds perform. If you can get rid of the losers and just count the winners, you can make your numbers look a lot better. Okay, so in fact, let's take a look at the next slide. This shows what the survivorship bias. This shows basically, this is one of the things, by the way, 32,000, almost 33,000 mutual funds as of 2016. Total number born, however, So that was how many were in existence at the end of 2016. Total number born, about 62,000. In other words, almost 29,000 mutual funds had been closed or killed off, as we put in this slide. Well, what happened there? Going back to 1923, when we look at all the funds that have been created, how many of those were closed and why? Well, let's take a look at the worst of the 200. Okay, the worst 200 mutual funds, a negative 81% average cumulative return. That's no wonder they closed them down, right? Well, this is what happens when funds underperform or do very poorly. The mutual fund companies will close those funds, move you over, or send you back your money. And what are you getting for, what happens? They don't show that. And then when they close the funds, they don't show the data anymore. They get rid of that. It can be very misleading when you're trying to figure out where to put your money. Well, here's another one. When you look at how much money is lost to active management, what we're looking at here is what the S&P 500 over from 1972 forward, by the way. So this is over about 20, 30, 45 years. Over the last 45 years, if you'd invested $100,000, how much would have grown? If you look at the average of U.S. mutual funds, 3,577,000. Okay, that's the growth. But if we compare that to the S&P 500, got almost double that over the same period, much like in that active managed bet. All right, so we see again that just an index fund would have way outperformed the average equity mutual funds out there over, and we're looking at here an extended period, 45 years, but we break that down as we just talked about with Warren Buffett's bet over the last 10 years, same thing. And if we go back, I like to use statistics going back to 2000 because of the two bears and the bull market we've had, two bull markets we've had in between. And again, but you see the same thing. This isn't it's consistently that the S&P 500 index is going, the market will outperform actively managed funds. Now let's take a look at the next slide. And in this one, we're going to take a look not just at equity mutual funds, but what if we we look at what the average investor actually does, what most investors in fact do, which is that we're going to invest in a combination of stocks and bonds or stock and bond mutual funds. Now if we look at the same graph in that situation, now when we compare all mutual funds, we see that the average growth now is only 1,700,000 on that 100,000. And if we compare that to a conservative portfolio utilizing indexing again, that strategy, right? Passive strategy versus active strategy, we see double, 3,500,000 over the same period, all right? And if we look at a moderate portfolio with 50-50, let's say stocks to bonds, and this is, by the way, these numbers are coming out of the Center for Research in Stock Prices, and this, CRISP as it's called, is out of University of Chicago. This is where some of we have probably more Nobel Prize winning in economics coming out of there. And this is where some of the academic research, much of the academic research, in fact, over the last 50 years on stock research has come from. And what we see here, as you can see, a moderate portfolio is $7 million, right? Wow, that's like 4 times the result of the average mutual fund. And that's a moderate portfolio. That's not overly volatile. In fact, that's going to be pretty easy. And it's what most people, I would say, when they come in, I'll see portfolios typically that range from about 40% stocks up to 75, 80% stocks, depending on the portfolio, on average. Again, there's always exceptions. Now, what this shows is that, again, when it comes to the money manager's ability to pick stocks, if they really could, in fact, pick the winners versus the losers, they would be outperforming those indices, wouldn't they? Right, but they're not. They're underperforming, which shows the exact opposite effect is what's going on. Now let's take a look at the next one. Myth number 2, this is track record investing. Now, when I started, I got my securities license. This is going back, about 20, almost 25 years ago, I guess. At that time, my broker-dealer at the time that I was in that broker-dealer system, and what I would get is what was called a proven performer list each month. And that proven performer list would be these mutual funds that we were told that these were the best ones to show our clients. So I would go out and do just that, and then would be very disappointed that these funds that were doing so well were then underperforming the market. So I thought, well, I can do better myself. I'm going to go out, and I bought some software, and I started doing my own research and finding out which funds, in fact, which are the top funds. I'd look at the top 10% of mutual funds in different asset categories, like large caps or mid caps or small caps. At that time, that was before I knew about some of the academic research that was ongoing at that time. And so I would just put these portfolios together, though, using all these categories, thinking, here we go. And then the same thing on the bond side. So what I found, in fact, was that these are all the money managers that had outperformed the market 1 year, 3 year, 5 year, 10 years even. And I'm thinking, all right, I've got this nailed. And we would put together the portfolio and put the clients in these, and guess what? They would underperform the market. And it's like, what is going on, right? I could relate to the client that comes in and says, as soon as I invest in something, it's going to go down. Well, you know why? It's because that we're thinking that because of their track record, because they've done so well in the past, that means they're going to continue to do well, and that's just not the case. In fact, the next slide will show just that. So let's take a look at what happened, in fact, with active managers. When we look over this the last 10 years, so if we're going to go back from, it's about approximately 20 years. So we're going to show a 10-year period, 1997 through 2006. And what we see is, in fact, that the top 30 equity funds, average return of 17, they'd like doubled what the market did. We would be thinking, great, these are the guys, again, that know how to beat the market, right? So what do? We invest at that point. And then what happens for the next 10 years? They underperform the market. What is that about? Well, that shows us again. Let's take a look at the next one even. Let's look at a 5-year period. How did that work out? Here again, what we see is that over the 5-year period, they average about 5. They way outperform the market. Again, we, of course, would invest once we find them. We see that track record, right? And then what happens? They underperform the market terribly, in fact. I mean, the market does like 3 times what they did. So what do we know from that? It tells us basically, right, that they just got lucky. They just happened to have the right mix at the right time. They were able to rack up a record with it. Through that, they market the heck out of it, right, and get you to, put that out there in the financial magazines and what have you. Get it marketed to different advisory groups, broker dealers, if you will, and then they get pushing pushing that out there. And then what happens? Of course, they underperform. And what it tells us basically is that with this, unless we knew in advance, right, which we don't. No one has a crystal ball. It's not going to help us. A manager's ability to pick stocks in the past, little or no correlation with their ability to do so in the future. So what we're looking at is basically, these are the first 2 myths. And again, this is all about active management. This is what active management does. It's about stock picking, track record investing, all of that, whether it's on the mutual fund side or whether it's your advisor telling you about, chasing these hot stock tips or these hot mutual fund tips, same concept. Does it work? And so far, it's showing it doesn't. What about the next one, which is going to be market timing? Well, we're going to take a break. When we come back, and market timing is one of the big ones, and this is one of the ones that I think I've seen many people really get burnt by. And we're going to talk about why it doesn't work and how you can, in fact, protect yourself against this particular myth, all right? But first, we're going to take a break. Join us here. We'll be right back on the Retirement Report.